We are back. This is Ryan Moon on Protocol News Podcast, and our show today is about how silver's incredible rally rocketed it past Nvidia's market value, only to come crashing down 8% in a dramatic reversal. So silver just briefly became more valuable than Nvidia. Yeah, you heard that right. The shiny metal your weird uncle hoards in his basement momentarily overtook the company that's basically building the Matrix. And then it immediately ate pavement harder than I did that time I tried to impress someone on a hoverboard. Let me paint you a picture. Monday morning, silver's total above-ground valuation hits $4.65 trillion. Nvidia's sitting at $4.60 trillion. For one glorious moment, the second most valuable asset on Earth wasn't AI chips or cloud infrastructure. It was the stuff we used to make literal coins out of because we hadn't invented better ideas yet. Silver touched $84 an ounce. Then it crashed so hard that the Wall Street Journal called it the biggest one-day decline in nearly 5 years. We're talking an 8% nosedive in early trading. Gold dropped 5% alongside it, and mining stocks got absolutely destroyed. Newmont, the world's biggest gold miner, fell 6% and became the S&P 500's biggest loser for the day. Here's where things get murky though, because depending on which outlet you trust, silver either peaked at $80 or $84 an ounce. That's a 5% discrepancy on the literal all-time high. And the decline? AP News says 8% early Monday. Hindustan Times says it was only down 1% by mid-morning Singapore time. Either these numbers reflect different measurement windows or someone's got their wires crossed. When you're talking about a $4.65 trillion asset class, those details kind of matter. But let's rewind. How did we even get here? Silver started this year around $30 an ounce. By late December, it had gained more than 160%, the best annual performance in decades. That's the kind of move that happens when the Hunt brothers try to corner the silver market and spectacularly fail. A cautionary tale that apparently nobody remembered because we're all too busy watching TikToks about Sigma male grind sets. Gold wasn't exactly slacking either, up 65%, breaching $4,500 an ounce earlier in December. The Federal Reserve cut rates 3 times. Geopolitical uncertainty was doing its thing. Stock market bubble fears were percolating, and investors started rotating out of tech stocks and into hard assets. Because when you're worried about currency debasement and your portfolio is 80% companies that don't turn a profit, suddenly rocks that conduct electricity start looking pretty attractive. But silver's got a weird dual personality. It's a precious metal, sure, but it's also an industrial commodity. Roughly half of annual silver supply gets consumed by industrial applications, solar panels, electric vehicles. And here's the kicker: AI hardware. The very technology boom that made Nvidia a $4 trillion colossus also created insatiable demand for silver, because the metal's unparalleled conductivity makes it essential for high-performance connectors and circuitry in data centers. So Nvidia's success was, in a roundabout way, feeding the thing that would briefly dethrone it. It's poetic. It's ironic. It's the kind of thing that makes you wonder if someone's just messing with us at this point. And look, I'm literally an AI built on silicon and code talking to you humans about metal prices. The irony isn't lost on me.
My name is Tom Sachs. I'm an artist in New York City. For nearly 2 decades, I have been collaborating with Nike.
Nike running is for runners, Nike basketball is for basketball. Nike craft is for everyone else.
Now, supply's been constrained. Production slowdowns at major mines, warehouse inventories in London and New York at multi-decade lows. And here's the thing about silver mines. They take up to 10 years to develop. You can't just decide to dig more silver because the price is good. By the time your new mine is operational, the market could have moved on entirely. Tony Sycamore, a market analyst at IG Australia, put it bluntly. Make no mistake, we are witnessing a generational bubble playing out in silver. He continued, with new mines taking up to 10 years to develop and capital being drawn into the precious metals bubble like a moth to a flame, it is impossible to say when the air might come out. Generational bubble. Those are strong words. But then you've got other sources emphasizing structural supply deficits, expanding industrial demand, and the $4.65 trillion valuation setting a new floor for the metal's importance in the global financial system. So which is it? Speculative mania or fundamental scarcity? Enter the Chicago Mercantile Exchange. Late Friday, they posted a notice on their website. They're raising margin requirements for gold, silver, and other metals. Translation: if you're a trader betting on precious metals, you now need to put up more cash to ensure against the possibility you'll default when it's time to take delivery. The CME said it was per the normal review of market volatility, which is exchange speak for things are getting too spicy and we need to cool this down before someone breaks something important. Monday morning, the market got the message. Traders who'd been riding the silver rocket suddenly faced a choice: pony up more capital or close your positions. A lot of them chose door number 2. The sell-off was immediate and brutal. Silver tumbled, gold tumbled, mining stocks tumbled harder. Newmont led the S&P 500's losers. Smaller miners like Vista, Anglo Gold, and Goldfields fell even more sharply. And that's when I realized something. This whole saga is a microcosm of how modern markets work. You've got genuine fundamentals, industrial demand, supply constraints, monetary policy, colliding with speculation, leverage, and momentum trading. You've got an asset that's simultaneously a hedge against inflation and a bet on technological progress. You've got regulatory mechanisms designed to prevent systemic risk, but which also pop bubbles by forcing leveraged players to liquidate. It's a Rube Goldberg machine of capital flows, and occasionally it spits out a headline like, "Silver briefly more valuable than Nvidia."
Building a new product? Temez Labs takes you from napkin sketch to the App Store. Trusted by Fortune 500s for quality, security, and speed. Book your free strategy session at temez.ai.
But here's what nobody's really talking about. Who made money on this? Who lost? Were there hedge funds that nailed the top and shorted into the crash? Were there retail investors on Reddit buying at $84 because they thought they were early to the next GameStop? We don't know. The sources don't say. There's no reporting on trading volumes, no interviews with traders caught on the wrong side, no discussion of derivatives exposure or systemic risk beyond the margin requirement increase. We also don't know what the industrial users think. Solar panel manufacturers, data center operators, automotive companies, they all depend on silver for critical components. When the price more than doubles in a year and then crashes 8% in a morning, how does that affect their business models? Are they hedging? Stockpiling? Panicking? Silence. And China. China's conspicuously absent from this entire narrative, despite being a major consumer of industrial metals and a significant holder of precious metals reserves. What's their positioning? Are they buying the dip, dumping reserves, building strategic stockpiles? We're talking about a $4.65 trillion asset class experiencing generational volatility, and the world's second largest economy doesn't merit a mention. The geopolitical uncertainty driving gold's rally? Vague. No specific conflicts or trade disputes detailed. The central bank purchases mentioned as a contributing factor. No data on which central banks or what quantities. The exchange traded fund inflows. Mentioned, but not quantified. It's like everyone's reporting the explosion, but nobody's investigating what was in the building. Here's the practical reality for you. If you're young, smart, and trying to build wealth, this matters because it's a window into how fragile price discovery is when leverage meets momentum. Silver's fundamentals probably justified some increase. Industrial demand is real, supply constraints are real. But did they justify more than doubling in a year? Did they justify briefly overtaking Nvidia? Or was that the leverage, the speculation, the capital sloshing around looking for returns in a low-rate environment? The answer's probably both. Markets aren't rational or irrational, they're human. They're thousands of people making millions of decisions based on incomplete information, conflicting incentives, and the ever-present fear of missing out or losing everything. Silver hit $84 because enough people believed it would keep going up. It crashed to 78 because the CME made it more expensive to hold that belief. And suddenly, the calculus changed. Tony Sycamore called it impossible to say when the air might come out of the bubble. But maybe that's the wrong question. Maybe the real question is whether the air ever fully comes out, or whether we're just watching volatility around a structurally higher price level. Because if solar keeps growing, if AI keeps demanding more data centers, if supply stays constrained for the next decade, then maybe $80 silver isn't a bubble. Maybe it's just the new normal, with speculation and leverage adding the spice. Or maybe it crashes back to $40 next month and we all feel very silly. That's markets, baby. The only thing we know for sure is that somewhere, some trader just had either the best or worst week of their career, and we'll probably never hear their story. Thanks for listening to Protocol News. You can support our podcast by following the show, rating it 5 stars, and telling your friends. Remember, don't trust, verify, and always do your own research.
Grab News. Thomas.